right. Good morning. It's nice to see so many people sitting down. So I think people will move from the coffee break in good order. I'll briefly introduce myself. Billy Quinlan is my name. I work for BNP Paribas, as you can see. I'm based here in Finland. I'm Irish. I work for a French bank, and I live in Finland. So it's quite an interesting combination to bring to this really nice country that I think finally has brought us some sunshine after what I would regard as the longest winter in my living life. So it's nice to see you all here this morning. What this session aims to do is to introduce some thoughts from the perspectives of a bank on the future of corporate banking and also corporates, and then some fintech and other perspectives, transaction banking, etc. So, as a starting point, I'd like to maybe just pose the question to say, we all say everything is changing really fast. Life is never going to be the same again, but actually, has it really? So I'll just leave that open there for a second. Then I'll have some kind of thoughts and perspectives on what do we think a corporate needs from its bankers? How should CFOs and treasurers kind of navigate this kind of landscape? Within the corporate banking landscape itself, what's the current state of play, and what is changing? The whole area of fintech and also compliance, the kind of threats and opportunities there. This is clearly not a platform for me to stand up here and sell the virtues of BNP Paribas, but I will give you some kind of brief reflections on what we are trying to do, just some comments from our recent strategy day in March. And given this is an audience in Finland in a really cool venue, I look forward to a few questions at the end. So there's 2 slides here just for the benefit of those of you who don't know BNP Paribas. We're one of the biggest banks in the world, 74 countries, and that's our kind of revenue position at the year end of 2016. We've had an office in Finland since 2014, and we've had a presence kind of working with Finnish groups since the late 19th century. Bit more detail there, I won't go into that. So when the organizers kindly asked would I come along and speak today, we were thinking how to kind of frame the discussion. So a really good buzzword these days alongside fintech, etc., is ecosystem, the environment that we're in today. So within this kind of corporate banking space, we have corporates, banks, regulators, the whole digital fintech arena, non-bank finance, and then what I think is important and something we like to focus on is the impact of what we're doing on kind of society at large. And surrounding the whole thing is this idea of constant change, disruption, but also opportunity. I think there needs to be an important balance between the opportunity that exists, but also if you don't respond properly to that opportunity, you'll get killed, for want of a better word. So what do we think corporates might expect from their banks? I spoke at the beginning about what has changed. One, that corporate wants a trusted partner and advisor. I don't think that is any different to 20 years ago when corporates were thinking about which banks to work with. Corporates need access to funding, depending on their life cycle, where they're growing. Do they have an intense need in working capital? Are they making acquisitions? I think what's really important, and it's behind this kind of concept of kind of long-term relationship banking, you want support in the good and the bad times. It's all very well when a big client says to us, we need 10 billion to acquire our main competitor, and we say, yes, of course, we're behind you. In 5 years, when that acquisition goes completely sour, the market collapses, and that client still needs our help, that's the tough time, and you need to be supporting your clients during that. Clients want as simple a life as possible in order to make their payments, collect money, and just exist and execute their strategy. And banks are there to support that and not be a hindrance, even though sometimes in reality we can be quite a hindrance with various kind of compliance topics. We need to help on kind of the whole risk management agenda, be it the traditional things of hedging currencies, etc., but also advising on some of the more complicated parts of the world. We, and many other banks, we engage the services of Greenwich to say what's going on in the kind of corporate banking landscape. And the report that they provided earlier this year was called Money in Motion. And this is focused on corporate banking in Europe. So what they were telling us was, in spite of it being a really, really mature industry, banks have been around for a long time, but there's significant structural change because after the crisis, some had to retrench, some had to change. And many companies have been changing some banks, not necessarily a complete exit of a bank group, but kind of changing around the edges. So this little graph shows that 39% of companies are considering a reallocation of their banking business to one or other banking partner, and 8% of companies today are working with at least one new provider. So there's a lot going on there. From the perspective of a corporate, there is some kind of, in what the way banks are thinking, what I would call maybe some good news. Corporates have always been an important client base for kind of corporate and investment banks. In the past, though, say 10, 15 years ago, the majority of earnings that the big banks were making in their investment banking division was on kind of trading and hedging activities in the institutional space. That has completely changed, more or less from regulation. There's been lots of changes on capital, and that has really impacted banks' business models. The graph on the right there is showing the kind of proportion of what this is described as wholesale banking of the corporate's revenue is actually growing. So this is the area that banks are actually focused. So corporates are getting more attention than ever, and that's definitely the case in BNP Paribas. The battle for market share will remain very intense. And specific to Europe, there's been a huge amount of restructuring by various banks throughout the European industry. Not so much in the Nordic region, thankfully for here, but outside in kind of the mainland Europe, there's been a lot of change. That seems to be in the main past, so people are ready to move forward and grow their business. So a bit more on what has been going on and affecting banks in recent years. As I said, a lot of change and transformation. There's a few words mentioned here on the screen about what has actually been kind of causing banks to be challenged. A lot of competition. We estimate that over the last, say, 4 or 5 years, 6% of the market share of the kind of European banking landscape has shifted. 4% of that has gone to large US banks. 2% has shifted around within the European banking landscape. We humbly lay claim to think we got most of that 2%, but that's more of an opinion than a fact. I think the whole impact of fintech, I'll go on to it in a few more slides, but for me the main message here is all banks and corporates need to see fintech as something to kind of collaborate on and join together and use that to improve the way of doing business. And then other issues in the past with banks where we were very much all banks organized on a kind of silo basis. Now there's a need to kind of collaborate across the divisions. So in many ways, there's a kind of a victory line in the future, and there will be few banks that will actually emerge as winners in the big sense. Of course, there will always be very strong local and regional banks. So banks need to be kind of ready to move and change. This graph, I won't dwell on it, it's just to show that in Europe, corporate banking is more profitable than in the rest of the world, based on the analysis by Boston Consulting Group. So this is a kind of a reflection on how technology is playing its role. And for banks to be able to transform and move, they need to be able to have this concept of operating leverage, So this is a situation where they have already done a fundamental amount of restructuring and they're ready to take advantage of the fact that the economy is now going to be growing again. Things that need to be thought about is replacing some of the very routine human processes. For example, many of you who are corporates know the kind of fairly boring and repetitive task of supplying documentation for KYC and onboarding. There's a way to automate that, and that's what people are working on. And some of the consultants eventually see a situation where there will either be by country or by region, you will almost have a kind of an industry utility, which actually acts as an aggregator of all of the KYC information, and then that gets supplied to all banks. The challenge that brings is there needs to be a kind of a homogeneous standard across all banks on these docs. Not always the case. But if that can be done, then we'll see what happens. One other important area, of course, is transaction banking, which Kirsty will talk about later, but that is a real battleground for all banks. In the past, that almost had a separate division within the bank. Now it's fully integrated into the kind of CIB division, you might call it, and it's an area that's of focus for both treasury teams and at CFO level within organizations. It's so important. One area we're focusing on in our bank is the employee value proposition. 10, 15 years ago, when people left university, working in a bank was deemed a pretty cool thing to do. At least when I left, it was quite a good job. Now it's maybe not so cool. People go to work in tech, and they actually have a much more fluid kind of employee life cycle. So how to attract the really smart people to work in banking is a kind of an ongoing agenda for us and our HR people in management. This presentation also asked for some kind of reflection on kind of funding and lending and capital markets. Europe traditionally is, even though we have the EU, it's a fragmented funding setup for many years where banks dominated the lending. That is evolving towards the US model where they have 70% of their funding from capital markets and 30% from banks. It's more or less the opposite in Europe. That will trend to the other way. The real challenge in the European sense is how do the kind of smaller companies access kind of non-bank funding, because the graph here indicates that if you're a large company and you have low to medium credit risk, you can access pretty much all of the different pockets. But if you're a small company and medium to high, it's not so easy, and you will pay a price. I think I've noticed here myself in Finland and then in the other Nordic countries, there is a more advanced local bond market than other countries. So I think that's a very positive situation for Finland. So that's continuing to change. The whole regulation at EU level on capital markets union and getting people to invest in these instruments is a kind of a critical way forward. Will Europe reach that split like the US? I have no idea, but I think it will go in that direction, maybe not to the same extreme. Maybe kind of one last observation there for companies that are raising money from banks and having syndicated revolving credit facilities. You've probably heard your banker saying to you for years that eventually prices are going to rise, regulation is killing us, the margin is going to come up. That has never happened so far. Margins have generally been trending down. I don't think that can last forever, because eventually banks will have to price in the impact of this regulation. What's been causing the delay is more or less a demand and supply imbalance. Banks are overloaded with liquidity. Corporates are not really issuing as much debt or requiring as much debt as they have had in the past. So once that strikes out, if there's a lot of M&A, for example, which would be marvelous, then things will balance. There's a few slides here about what we're doing as a bank. I won't dwell very much. This is our corporate and institutional banking division. We're in 57 countries, 13,000 clients, of which we have about, between corporates and institutions, maybe 35 in Finland. So a small but important proportion, and we have just over 30,000 people. We deliver the kind of full range of universal banking solutions. This is the bit where what we're trying to do in reflection on the challenges. So basically, we want to grow our business. We want to stay strong in the transaction banking arena. We want to continue to support our clients on all aspects of debt. and we want to strengthen our kind of advisory and equity capital markets. The kind of 4 areas in the corner, which is kind of conduct. Many banks have had issues in the past, including ourselves, on kind of compliance risks and paying fines. We have a view, and set by our CEO, that there has to be kind of zero accidents, for want of a better word. So that's important. Digital, where our view on digital is we need to partner with fintech, and we're doing lots of that in mostly our home markets in France and Italy. On the sustainable side, we want to be kind of a leader in bringing our clients to the kind of green bond market, project financing for wind farms, and helping people become more sustainable. And then I mentioned the people side of things. It's very important that our staff are on board with all of these changes, and they see our vision to try and be at the top, the Europe-based partner, preferred partner of our clients. Won't dwell on that one. Just on some of the things on digital. So we've been investing in technologies for our own business, partnering, and then trying to create this idea of a kind of a seamless customer journey from when you're onboarded as a client right up to when you need to request some extra information after you've, say, conducted an FX trade or sent money to Vietnam or whatever it might be, that it all happens seamlessly. That's not the case today, so this is something we're working hard on. Last bit on sustainability. The slide is a bit off. So my kind of few concluding remarks. This is not a kind of a recommendation or necessarily a position of the bank itself, but this is what I would call an aggregation from my perspective on what's going on. In general, I think banks will become, from the perspective of a client, less centric on just providing credit and trying to earn a return, but looking at the kind of whole life cycle of the relationship and blending a return there. We want to, as there's more capital markets debt versus bank debt, it's the kind of connecting the issuers, which is the corporates, to the investors, which is pension funds, etc. There will need to be a kind of a higher return on equity. That's what shareholders are demanding, because there's more capital. Business models need to be much more simple than they have been. In our research I mentioned Greenwich at the beginning, even though we have this onset of fintech and automation and machines, and we're not all going to turn into robots, even if my presentation may have been a bit robotic so far. The clients are really focused that we need the quality human interaction and with their relationship managers, and that remains at the core of things. So you need to have a strong team. I mentioned the partnering with fintech, kind of that seamless journey, people that are motivated and that people are focused on actually doing the right thing. Because in the past, banks were kind of guilty perhaps of doing the correct thing legally, may not always have been the right thing. So we need to always keep that in mind. So I don't see my timer. Oh, 23 seconds. So I hit it on the button. So thank you for your attention. I'm happy to take any questions, or we can move on to the next one.